Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, welcome everyone, and thanks for tuning into the Millionaire Next Door podcast. I'm Robert Curtis, your host on this podcast. Today, we're going to go a little bit further deep into the world of alternative investments. We have a repeat guest, Phil Huber from Cliffwater. He was with us about 9 months ago, episode 55 on August 13th. It's now mid-March of 2025, and markets are definitely experiencing a major increase in volatility. So this is a good time to maybe take a look at this and get some broader perspectives. We've found some of the alternative investments have really kept us sort of out of that fray and the volatility and help provide additional diversification and stability to portfolios. But with somewhat long-winded introduction, I'll introduce Phil. Thanks for being here, Phil.
Thanks for having me back, Robert. Great to be here.
Yeah, it's terrific to have you back. And why don't you just go ahead? I know you wanted to cover maybe your broad asset allocation outlook, some other thoughts. Why don't you just dive right into it?
Yeah, that sounds great. So especially times like right now when we're recording where volatility's picked up, we're kind of wired to think short term as human beings. And so I think it's helpful at times to take a step back, remind ourselves that we're long-term investors. And something we do at Cliffwater every year is we in January every year, we publish a asset allocation outlook across all asset classes, both public and private, traditional, alternative, with a 10-year type horizon in mind. And I think that's really important in setting these capital market assumptions for us to then go about constructing portfolios. And so you mentioned, I think earlier, Cliffwater being an alternative asset manager. That's where we focus our efforts in terms of asset classes that we cover, predominantly private debt and private equity. But I think it's helpful also to have a view on what traditional asset classes are offering investors over the long term, because that helps inform where we think we can position private markets in a diversified portfolio. So when I look at starting with the traditional side of things, if we look at the public stock market, our 10-year expected stock return, depending on U.S. versus non-U.S., essentially it ranges from about 7% to 8%. We have a slightly lower expected return for non-U.S. equities, hovering around 7% and just under 8% for U.S. equities. The way that we come up with that number, it's not just putting our finger in the air and giving our best guess. It's also not, I should mention, it's not tactical. It's not thinking about what's going to happen over the next year or even 3 years based on valuations or anything like that. It's really getting back to basics, getting to fundamentals, which is when we try to decompose the long-term returns of equities, what we find is that the valuation component can be really impactful in the short term. That's sort of the noise of the market. It's what investors are sort of willing to pay for stocks in a given time based on the headlines of the day. That tends to wash out over longer periods, where your longer term returns are really ultimately a result of two key components, which is your cash yield, which we define as your dividend yield, as well as your buyback yield as well, and combining those two into one metric. Today, that for the U.S., it's about 3.25 when you add those two together. And then earnings growth expectations, which have been relatively high in recent years. Not that we're predicting a major collapse in earnings growth. It's just more from a long-term perspective, kind of anchoring to where things generally will coalesce over a longer time horizon, which in our view is a combination of U.S. or real GDP growth and inflation, and adding those two together. And so the combination of those two right now, we have a forecast of a little over 2% GDP growth, 2.35 CPI inflation. So adding those two together, you get to roughly 4.5% earnings growth. And so that's how you calculate this almost 8% expected return for stocks. It's a combination of that all-in cash yield as well as that earnings growth assumption. For non-U.S. stocks, we estimate about 3.35% earnings growth. Interestingly enough, on the non-U.S. side, you tend to find higher dividend yields in foreign stocks, but lower buybacks. And so when you kind of net out those two, they almost offset one another. And so this is our view as more of a buy and hold return expectation. The other thing I'll mention as well is that we don't bake in any expectation for alpha from manager outperformance, and particularly in more efficient asset classes such as U.S. stocks, where we think this is an approximation of what you might earn in a passively held index fund with low cost. Another comment there too is we often get asked, well, do you think growth stocks are going to outperform value stocks or vice versa? We tend to keep things pretty general in our asset allocation outlook, just because these style bets can really last longer than people might realize. Everything, a lot of listeners might have heard of the value premium, which is this historical outperformance of value stocks over time. But we've really just lived through a multi-year, in fact, multi-decade period of growth stocks outperforming by a pretty wide margin. In fact, if you go back to the inception, I believe, of the Russell 3000 indexes, which have a value and a growth subcomponent to them, growth stocks have actually outperformed over that full history, about 12% for growth stocks, 11.5% for value stocks. So pretty neck and neck. And what's interesting there is it's not that growth stocks have been beating the pants off of value stocks for that entire period. In fact, that relatively small outperformance over the full history there has really just come in the last 5 to 10 years of growth sort of catching up to prior underperformance. So I think we try to stay a little bit neutral and express a bit of humility in these, where we're not trying to encourage investors to overweight one side of the coin or the other, but rather have exposure to both. They're going to perform well and not so well at different times. Rebalancing can be your friend here, but not to really bet the farm on either style.
Yeah, that's really good. I love these longer term. We're taking kind of a deep dive into markets, which I love for folks who are attuned to that. Just emphasizing the longer term. We are seeing a lot of noise, a lot of volatility. I like looking at the longer term, and you're setting reasonable expectations. That the podcast is the Millionaire Next Door, thematically sort of the overnight 25 or 30-year success story. So we just, that's where we really ultimately see success with that longer term. Some folks now are just not attuned to longer term, right? People's attention spans have decreased rapidly with these quick clicks. Everybody wants the quick solution, the quick fix. They might not want to do the work or invest the time that it takes. They don't want to go to the gym and have a full routine. They just want the instant result. Well, I don't think it really works too well like that. So I love that you're pointing this out. That's a little bit of a divergence, but I just wanted to put it into context because I've been doing this now close to 28 years with second, third generation, clients. And where we see folks go wrong is just trying to take these tactical bets or make things happen too fast. And a lot of times, just opens up the opportunity. They'll do something wrong, and maybe they're missing these bigger picture themes that are sort of the secret sauce, so to speak, although it's not that secret for doing well in the long run. So let me kick it back to you with some keep going. Yep.
Yeah, and I think it's important too to remind ourselves that as we establish these outlooks, we're not planting our flag saying we think this is exactly what stocks are going to do over the next 10 years. In fact, when you establish these expectations, you go in knowing that when we sit down 10 years from now, we're going to be wrong in one direction or the other. It's just a matter to which degree. Particularly when it comes to stocks, where there is this sort of valuation component that's more driven by human behavior, that's a little bit harder to predict. In fact, a lot harder to predict. As we move from stocks to bonds and cash, this is where the math gets a little bit more simple, and particularly over long horizons, more predictive. And so we have more confidence, I would say, in our bond and our call it T-bill expected returns, because ultimately it's about as simple as it gets. For bonds, we're just using the yield to maturity of the aggregate bond index, which as of the end of last year stood at about 4.9%. It may sound simple, but when you look at historical results and you say, okay, what did bonds then do 10 years forward from your starting point, there's about a 95% correlation between starting yield and total returns. You get a lot of variance in the short term where price movements in bonds can look a lot different than your expected return. The way to think about that as an investor is ultimately either a pulling forward or a pushing away of that long-term anchor of your yield. And so when prices, go up in bonds, it's not extra returns, so to speak. It's just sort of more pulling forward future returns and maybe lowering expectations from there. But there is a pretty tight correlation, so we feel pretty confident that for those that can kind of hold their nose and own bonds for the next 10 years in kind of relatively core type fixed income, you should expect, call it 4.75% to 5% returns, because that in bonds, that's really where your return comes from, is the yield, less so from appreciation. Cash and T-bills here, it's really just our inflation expectation, which is 2.35% plus an additional 1%, call it risk premium for T-bills, so 3.35 for T-bills. The way that we calculate that inflation expectation of 2.35%, I think everyone is familiar that the Fed is trying to kind of target a 2%. Long-term inflation rate. For a long time, up until the last few years, they were trying as hard as they could to get up to 2% when inflation was stubbornly low. Now they're having the opposite problem, which was the sort of elevated inflation we've all lived through and continue to live through. It's really that last mile. It's become the most challenging. It's one thing to go from 9% down to 6 and 4. It's really getting from that kind of 3% sticky inflation down to that 2% target that's going to prove, I think, the most challenging. But our expectation is really just the way that we set that is it's a market-based measure, where we have the benefit of there is nominal treasuries across different maturities, and we also have TIPS, or Treasury inflation protected securities, that exist at different maturities on the yield curve. And the way that you come up with a market-based expectation for inflation is really just what is the differential in yield between an inflation protected bond at 10 years and a nominal or non-inflation protected bond at 10 years. And right now, as of end of last year, that was about 2.35%. So that's how we come up with that assumption. And so one thing that we do with our capital market assumptions, we're not the only advisor or asset manager that publishes these. You probably see them all in your inbox every December or January, Robert. We have the benefit of being able to compare and contrast, and so we've aggregated a survey of 14 of the largest allocators and advisors that publish these annual capital market expectation outlooks, and try to compare what do our assumptions look like relative to the consensus. And in a lot of cases, we're pretty close. But in some cases, we're unique or a bit different. And I would say a few areas that we're different than our peers. One would be on the U.S. stock part of the equation, which right now the consensus of those other 14 is about 6% for the next 10 years, so about 2% lower than ours. And then generally what you find across the efficient frontier, if you will, is that given the strong equity performance of the last couple of years and the weak fixed income performance, which has resulted in elevated bond yields, what you found is, relative to years prior, it's more of a flat risk return spectrum than it maybe has been in years past, where there's been more of a gap between what bonds offer and what stocks offer. Now it's a bit more narrow. And so that has implications for asset allocation, where perhaps there's more of a case to be made that bonds can play a larger role in a portfolio versus 3 years ago when rates were stuck near zero. The other areas that we're a bit off of consensus, where most of our peers have expected returns for private equity and private debt or private credit about 2% above their public market equivalents. Ours are a tad higher, about 3% expected higher above their public market equivalents. And then similarly, on the risk assumptions for those private market asset classes, many of our peers, what they do to come up with, given that these are illiquid asset classes, they're not marked as frequently as public markets. And so there's this sort of overstated, or I should say understated, volatility or risk, because when you have something that only marks once a quarter with a lag, it might appear at the surface to be very low volatility. And so you do need to make some effort to de-smooth that, where the actual shown volatility is not necessarily reflective of the underlying risk. But we think there's a right way to do that, and maybe a bit of a wrong way to do that. And what we find is a lot of our peers essentially just swap the volatility assumption for their public market proxies into these private market allocations, which we don't think is the right way to do it. Ultimately, the volatility is lower. But we also want to make sure that we're not understating the risk of these asset classes. And so we find that our risk assumptions are modestly lower than our peers for both private equity and private debt. So that's sort of the forward-looking expectations that we have. I think it's also then important to say, especially for these private markets, what has history demonstrated? Like what's realistic? What have investors been able to actually capture? Are those expected return premiums real and reasonable in nature? And so I'll pause there, but in a moment I can get to some index data that we've calculated at Cliffwater that I think helps inform not just where we think things are headed over the next 10 years, but kind of where we've been in the last 20 or so.
Okay. Yeah, no, that's great. That is super helpful, kind of a deep dive. Do you publish anything or do you have a thought on real estate just because it's a big broad asset class that or is that not within is that not something you look at?
We do. No, we do. In fact, we have expectations for, everything under the sun, really. All, publicly traded REITs, private real estate,
Oh,
high
got it.
yield bonds, commodities, et cetera. I was trying to just sort of keep things simple with the major
Yeah,
food groups today. I don't have the real estate number in front of me. I want to
it's
say
okay.
it's 6 to 7%, I think is somewhere in that range. I think we're becoming we've been, I guess, a little bit bearish on private real estate as a firm the last couple of years. I think that's starting to thaw a little bit where maybe valuations have sort of bottomed out. I think maybe peak to trough declines in private real estate have been about 20%. And a lot of the, maybe bad news has been priced in at this point. And so maybe a better forward looking outlook for that asset class than we might have had a year or two ago.
Gotcha. Do you want to maybe comment on some of the convergence of public and private markets?
Yeah, I think that's a big theme that we've been witnessing the last 5 to 10 years, where, starting with credit, direct lending, private debt has really taken on a life of its own. I think Cliffwater, we were pretty early to the asset class. We've been, in addition to our funds that we have, we created the most commonly used benchmark or index for that category back in 2015. That has data going back to September of 2004. And so essentially the creation of that index was a reflection of where we thought the puck was headed in terms of the growing interest and adoption of private debt as sort of the next institutional asset class. And what we've seen today is it's sort of you're finding this sort of constant tug of war to a degree between bond markets, banks, and private lenders in terms of providing loans to businesses, predominantly in the middle market in the U.S. And that's, private lenders have taken the lion's share over the last, decade plus. That's been largely a result of post GFC regulations, banks sort of taking a step back in their lending activities. And that's where private lenders have really stepped in to fill the void. But it doesn't go in a straight line. You'll see periods where it's almost like a little bit of a tug of war where banks will take back some share and then give it back to private debt, over time. And so it'll be a function of different segments of the market having different preferences, how much competition there is, how much activity or deal flow or M&A, there is out there. Ultimately, if there's a more activity constrained environment, then you've got more capital and more players chasing fewer opportunities, which could have impacts on yields. And so I think really it's become less the sort of bifurcated distinction between the two segments, where now they're ultimately kind of working in parallel and coexisting in harmony with, maybe not harmony is not the right word, but coexisting. And we expect that to continue over time. And also too, just trends like you're seeing more of a focus on the private credit side on investment grade private credit, which sounds almost like an oxymoron to a lot of folks that just assume that all private debt is non-investment grade, junkier, whatever the expectation might be. You're actually seeing more of a push, particularly from the really scaled large private lending platforms to create investment grade type offerings and compete for that business with historically have been the bond markets. On the equity side, obviously companies have been staying private a lot longer. And so this notion that you have a startup that raises some venture capital and then eventually grows to a certain scale where it used to be that it was a sign of you've made it if you were able to be quality enough to enter the IPO markets. And we're seeing that less so be the case now, where more companies are saying, hey, why do I want to get into the public markets, have to deal with quarterly shareholder expectations, additional, legal and compliance costs that come with being a public company. And so many companies deciding they can stay private for longer, if not in perpetuity, and that there are private equity solutions that can support private companies along every step of that journey as a corporation. So it used to be the case that kind of the old days that private equity or venture capital played a role at the very earliest stages and the very latest stages of a corporate life cycle. Particularly venture at the early stage and buyout private equity more at the later stage for mature companies. And now you're seeing more of a continuum where you've got growth equity in private markets and just more optionality for companies that don't need to necessarily go public if they don't feel like it's in the best interest of their business or the direction that they want to go. And so I think what that's meant for allocators or folks that are putting together portfolios is thinking less of credit and equity, public versus private, as sort of these distinct buckets, and even less so thinking of private debt and private equity as quote unquote alternatives, because ultimately they're still harvesting or capturing the same risk factor or return premium. You're bearing credit risk or you're bearing enterprise risk or equity risk. It's just a different form factor. And so what we've seen allocators do a lot now is really, just think of it, a private equity as a good example. It's just a component of their overall equity allocation in the same way that they might have US, your S&P 500, but then you've got some small cap exposure and some foreign stocks. To me, it's a similar decision matrix today with private, not so much should I be invested in private equity, but how much of my total equity portfolio, what's the right amount, what's the best access point, how can I achieve the right degree of diversification to try to improve my odds of successful outcomes in that asset class. And so that's the other sort of convergence is it used to be like daily liquid public markets, and then truly illiquid private markets with a decade long or longer for getting your capital returned. Now you've got the emergence of solutions that can kind of bridge that gap where there's more of a continuum on the liquidity spectrum as well.
Yeah, very, very helpful. I know the private markets are much larger than most people might realize relative to the public markets. And, another theme we've talked about it somewhat extensively is just in most people's 401ks and qualified plans and stuff like that, that could easily be their largest investment. To date, they really don't have any access to this. So, it's something you might want to put in there. But yeah, keep going. That's super helpful. I like the convergence, the fact that it's not these buckets. Things are evolving for sure. And
Yeah.
And they're changing. Yep.
And so back to the historical returns for private debt and private equity. So we have two sets of data. These are not our funds, but really are kind of indexes, if you will, that have a longer time horizon, more exposure to different cycles, and more kind of battle tested to give us a better sense of how these asset classes have performed, not just the last 5 years, but the last, call it 20 plus years. And so starting with direct lending or private debt, we created, our founder, Steve Nesbitt, created in 2015 what's called the CDLI, which stands for Cliffwater Direct Lending Index. And this has ultimately become, in my view, called the S&P 500 of private debt. It's become the most commonly referenced benchmark that private debt managers use in assessing their own performance, in helping educate the broader marketplace on historical risk and return in this asset class, which ultimately helps inform allocators like us, like you, in developing assumptions for the asset class. And so what this index is it's comprised of today about 17,000 loans representing about $400 billion. And where we get all this data from, because you might think, okay, well, it's private markets. It's how readily accessible is this data? We're not using fund manager performance. What we're doing in the case of private debt is actually using publicly available quarterly SEC filings from what are called business development companies, or BDCs. And BDCs are in the business of essentially owning middle market private loans, is what they do, even though some trade on public exchanges, others are private BDCs, but all kind of lumping them together. Because of the way they're structured, they have to offer this data on a quarterly basis to the SEC. So our index essentially goes in and scrapes that. And so we created it in 2015. We were able to go look backward to 2004 to get more of a history, more data. And what that's shown us is that since that 9/30/2004 inception, the return for the index has been about 9.5%. And that 9.5% is really almost entirely driven by income returns. That's what you're getting in the private debt asset class. It's not this sort of upside potential that you're going after like you are in equities. You've got this more asymmetric return profile where you know what your upside is, and then your net returns are going to be a function of how much of that yield are you keeping from credit losses that are inevitable as part of this asset class. That's the risk you're bearing. There will be credit losses. The question is how much. And then fees and expenses, obviously, will come out of investor net returns. And so what we find historically is that the income returns of the index have varied between 8 and 12%. And that yield is a little bit different than what you find in traditional fixed income, where there's two main components. You have a fixed credit spread when the loan is made, and then you have what's called a reference rate, which is floating rate in nature, and that's based on short-term rates. And so what you found in this asset class is that the income returns are going to be driven by those two variables. And the credit spread component, as you can imagine, is going to become more elevated in periods of economic distress and narrower in times of less distress. And then the reference rate will also be, is the Fed lowering or raising interest rates, because that'll ultimately feed into those yields as well. And so that floating rate nature of this asset class, in our view, provides a really nice complement to core fixed income, which is not floating rate, it's fixed rate. And so it's more susceptible to price decreases when rates go up, whereas private debt doesn't have that same dynamic. In fact, in a year like 2022, when rates went from 0 to 5, private debt offered positive returns because essentially the yields went up as short-term rates went up. And then what we find as far as net returns go, I mentioned the 8 to 12% starting yields. What we found is that credit losses in this asset class have averaged about 1% annually. So think of that as about a 2% default rate historically, with about 50% recovery. And so your default rate times your recovery rate is ultimately what the actual credit losses might look like. And so we think this is a very compelling risk-reward trade-off. You're still going to have periods of credit losses over time. We don't think anyone has really the ability to time it, but we think for long-term investors, for similar credit quality versus high yield bonds or publicly traded leveraged loans, there's a substantial yield premium. And in our view, if you can handle the illiquidity the asset class offers, it should lead to a sort of a crowding out effect where there's just a much more compelling rationale to invest here versus the public market equivalents, given the higher yield that you're receiving for that. And what we found is in that 20-year history now of the index, direct lending has outperformed all three of high yield bonds, leverage loans, and the Barclays, or I should say Bloomberg aggregate bond index in 13 of those 20 years. It's outperformed all three. And then from a return standpoint, I mentioned the 9.5% index return. That's compared to about 6% for high yield bonds and 3% for core bonds like the ag. And so allocators really like what they see here. We study pension data a lot because that's also publicly available. All state pensions have to publicly file these annual financials, which gives you information to how they're allocating capital. And what we find is that private debt has grown at about a 20% annualized clip over the last 10 years for state pensions, which might surprise people when they see the average private debt allocation of a pension portfolio is actually only 4% today, which might seem small, but given that it's a less mature asset class than private equity, in fact, over half of state pensions still have zero allocation to private debt. So we think there's still a lot of runway for continued adoption, not just in institutional portfolios, but also in the private wealth channel as well.
Well, great. You sort of answered a question I was just going to bring up in terms of, and that was just a great dive on the depth that you understand at the creation of the index. Looking at 17,000 credits probably gives you a lot of depth and insight with respect to what you're actually putting in there. But you mentioned what's been very good for you was seeing where the puck was moving and getting to private debt early. It sounds like you still think that's where the puck is, or a good place to be. Are there other things you see that are really emerging, or is that sort of a major staple? And just curious, I thought I'd throw that out if there's any other areas you see that are really on your radar, or you're poised for looking for opportunity, or just thought I'd put that out there.
Great segue into our other big opportunity we feel is private equity. And that's something, Cliffwater is a firm. I think we've been more known, I think, as a private debt specialist over the years. But if you think of what our history is of the firm, it's been as a consultant to large institutional pools of capital across all types of alternative investments. And so we've actually been allocating to private equity longer than we have private debt for our institutional clients, which is now over a 20-year period of these activities. What's become the big trend in the last several years that we've participated in is, and this gets back to the convergence, discussion from earlier, is the ability to access private equity in a highly diversified fashion without some of the operational headaches or constraints of traditional private funds, that's been, I think, the big hurdle for a lot of individual investors, where they might have been very interested in private equity, but up until recently, the way to access these funds has been a bit challenging for a variety of reasons. You have the management of capital calls that you have to deal with. You have the kind of uncertainty around the timing and magnitude of distributions that you might receive. You have sort of this finite life cycle where these private equity funds are, there's a fundraising period, there's an investment period, and then ultimately a harvest period. But you're looking at a 10 to 12 year span where ultimately the whole objective is to return capital to investors, which they then decide, okay, what do I now do with this? Do I re-up with the same manager? Do I allocate to another private equity fund, et cetera? The minimums are often exorbitantly high to go directly to these funds. The limitations have been around for certain types of investors. In other words, qualified purchasers, which means any investor with less than $5 million of net worth, hasn't really had the ability to invest in private equity up until recently. And just complications around subscription documents and, K-1 reporting for taxes, and just a lot of operational headaches that most folks, that if they're not used to this type of investing, it just may not seem like the juice is worth the squeeze if they're more accustomed to investing in mutual funds or ETFs, where structures like interval funds, which is the types of funds that we operate with, try to alleviate some of these pain points with lower minimums, broader accessibility, becoming more fully invested immediately versus having to have your capital called over multiple years. And I think the most important benefit is this notion of getting diversified exposure. That's really the big takeaway for private equity. And I'll reference, we have another index at Cliffwater. We're big on compiling data historically that's not related to our funds, but I think trying to set expectations with what is private equity actually delivered for investors over time. And so we did a study with pensions. And so 94, I believe, state pension systems, and they publish their annual financials. We like this versus like a traditional fund-based benchmark because it's a closed group, there's no selection bias, and you're actually getting net returns achieved by institutional investors. In other words, these are real actualized returns of the private equity allocations of state pensions. And what we have now is a 24-year history of data through June of last year. And what we found is that that equal weighted mix of pension private equity portfolios delivered 10.7% net returns. Compare that with the global public stock index of 6.6% over that period. That equates to about 4% annualized outperformance. And so that's our way of saying, hey, the demonstrated or expected outperformance from private equity has been real. We've been able to calculate it over a pretty large sample size of real portfolios. And interestingly enough, over a rolling 5-year basis, we also found that private equity beat public 90% of the time with an average outperformance of 5% per year. The trick here, though, is those are averages. If we look within the sample at how did the best pensions do and how did the worst pensions do, you do start to get a little bit of a different story. If you look at the bottom quartile of pension performance, what they found is that those private equity portfolios underperformed public equities about half the time. And so that speaks to the big risk in private equity, because I think there's this notion or this term that's been floating around a lot lately called volatility laundering, which is people saying rather than this expected illiquidity premium for private equity, it should be a illiquidity discount, because behaviorally speaking, because people's portfolios aren't marking as frequently, it gives the appearance of lower volatility, and that's something investors, behaviorally might be willing to pay up for. I think that's one way of looking at it. I would take a different vantage point, which is, yes, volatility, the stated volatility is lower, but you're trading off one risk for another. which is illiquidity risk, which is a real risk. And as much as it might create this illusion of low volatility, which can have a behavioral benefit, at the end of the day, liquidity is an option and all options have value. And so if you are sacrificing liquidity, you're giving up that value. And so that's you're essentially sacrificing flexibility and creating an opportunity cost by committing to long-term illiquid private asset classes. And as such, you should be compensated for that. The other thing that you're bearing as an allocator to private equity is manager selection risk or adverse selection, meaning as I mentioned earlier, you can have a really great outcome in private equity or a really poor outcome, and ultimately that will boil down to how good your manager selection capabilities are. And that's what we think is critically important for investors that are considering an allocation to private equity, is that you don't want to just commit to one manager or one fund or one vintage year and call it a day. That's not the right way to build a private equity program. You want to thoughtfully construct a portfolio across many different managers, many different vintages, many different styles to ultimately remove the tails in both directions. You can still capture that private equity premium, but what you don't want to risk is committing your capital for a decade or longer and not having much to show for it when all is said and done. And so that's what we think the bit, back to the point of evergreen solutions, is that you can get that broad diversification in one commitment or one allocation, as opposed to having to go more bottom up and allocate to 20 different managers separately, which creates enormous operational complexity and also requires an enormous amount of capital to actually be able to deploy at scale. And so that's so what we've seen, again, that 4% historical outperformance of private equity, our go forward expected returns about 3%, so a little bit narrower than historical. And I think that's just a function of, again, as these asset classes grow and mature, you maybe don't expect the same outperformance, but still material outperformance to the early years of the asset class.
That is great. I mean, first and foremost, that you've made it simple. That's helpful. All those complexities you mentioned. That's what we're trying to do, is make people's life simple, give them access to all these exposures, at reasonable capital levels, just keep their life simple, but yet not sacrifice the complexity of all the intricacies of the processes you use to pair these things up and build something that has a lot of meaningful value for folks. I do want to respect your time and the listeners too. So I think it's kind of time to sort of start to land the plane. I didn't know if you had any closing thoughts or anything kind of key that you didn't come up yet that you thought might be good to share. Otherwise,
Yeah, I think one thing to bring up would be, a lot of investors are wondering, like, what's the, even if they're interested, what's the appropriate level of private markets to have as part of a diversified portfolio? The disappointing answer is there is no right answer. It's going to be largely a function of investor circumstances, appetite or ability to take illiquidity risk, overall risk profile, et cetera. So it's hard to come up with a blanket X%. But I think there's a lot of advisors, in my experience, kind of start with the global market portfolio as at least the starting point to then make overweight, underweight decisions based off of. And I have a couple numbers here, which I think may be surprising to people, just given how much growth there has been in private markets the last decade plus. If you looked at the global market portfolio today, like, what do private markets comprise of that? And so there's a study that Dimensional Funds put out recently that they're using data as of the end of 2022. So I think my assumption would be that the number would be a little bit higher today. But private markets across credit, equity, real estate, infrastructure, other private markets, aggregate all those together, and that was about $12.5 trillion. So big absolute number. And then when you compare that to the kind of total market capitalization of publicly traded stocks and bonds and other forms of public assets, what they found was it's about 10% of the global portfolio is private markets today. And that might be higher than some people assume. And in fact, it probably was a rounding error 20 years ago. And so just from a starting point, that might be a good baseline to work off of, and then kind of size up or down based on other variables. And if you just look at equity market alone, and just private equity and venture capital as a percent of total equity, it's about 11 or 12% as well. And interestingly enough here, despite being a minority from a capital standpoint, 11, 12% is nothing to sneeze at. And also, the number of companies is dramatically higher in terms of private equity and venture-backed companies globally. There's about 215,000 of them relative to the roughly 8,800 public companies globally. So that's a factor of about 25 times. So there's a much wider opportunity set in private markets for managers to go out and try to capitalize on. And so that's just maybe one thing I would leave listeners with.
That is great. That is just so much great detail. I think there's a lot of great wisdom in that the nerds who listen to this, myself included, are going to love it because you shared all kinds of data that really gives us a lot of insight on your process. And thank you so much for being here. I'd love to have you back several months down the line because there's just a lot to go into and explore. Thanks everyone for listening to the Millionaire Next Door podcast. We're going to continue to bring you terrific guests like Phil and just cover things. If anybody has any specific questions or things they'd like to really hear discussed on the podcast, please reach out to me directly. Thanks. Make it a great day. Appreciate you being here, Phil. Thanks so much.
Always a pleasure. Thank you.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities LLC, member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.